Hello and welcome to the Global View on this Wednesday. Well, let's take a look at what's going on at the macro level. US Treasury yields climbing to fresh 16-year highs on concerns that interest rates will stay higher for longer after job openings unexpectedly increased in August in the States. Labour demand jumping 690,000 to 9.6 million, well above the median forecast for economists. Well, the US 10-year Treasury note reached 4.8%, the 30-year yield hitting 4.95%, while the interest rate sensitive 2-year was at 5.15%. And Cleveland Fed President Loretta Mester has said if the current state of the economy holds, she's open to raising rates again, saying if the economy looks the way it did at the next meeting, similar to the way it looked at our recent meeting, I would do the further rate increase. However, Atlanta Fed President Rafael Bostic has said with the US economy slowing and inflation falling, there is no urgency to move again, saying, I don't think there is an urgency for us to do anything more. I want us to hold. I think that is the appropriate thing to do for a long time. And the Fed next meets at the end of the month, and 12 of 19 officials projecting at the last meeting that one more rate increase would be needed. When the US dollar rose against most major currencies on the stronger than expected jobs data, although the yen strengthened sharply, leading to speculation that Japanese policymakers have intervened to support the depreciating yen. The Aussie dollar has come under further selling pressure to be trading at 63 US cents. All right, well, for more on what's going on at a macro level and how that is informing investment decisions, joining us now is Tulare Capital CIO Hugh Selway-Smith. Hugh, good to catch up with you again. Thanks for joining us. So a lot of action going on stateside, isn't there? Particularly with the focus being on where those Treasury yields are heading.
Well, absolutely. I mean, I think what's clear is that there is no intention of the US government to reduce the fiscal deficit. So that's increasing as far as the eye can see. So the compensation that investors in the Treasury market are requiring because of the uncertainty, 10, 20 years out, is increasing. So the so-called term premium has risen about 200 basis points. Andrew, I think it's interesting if you have a look at 5-year inflation expectations as measured by the market, they're around about 2.5%. Now that's the same as they were 5 years ago, 10 years ago, and yet, of course, we're talking about 17-year highs in the bond market, and clearly that is going to feed through into the real economy in that typical lag of 18 to 24 months.
All right, well, let's talk about that lag, and of course this comes ahead of the next earnings season, which is upon us in the States. What can we expect? Because we were talking about this yesterday too, with the Reserve Bank, of course, leaving rates on hold and conscious of the fact of the lag effect that the rate hiking cycle has. How is that playing out in the States?
Yeah, well, I think I'd just say to people watching, it's quite natural that it takes around 12 months after the first interest rate rise to see that feed through into the level of corporate revenue growth. And then it really takes another 12 months until companies react to that slowing growth and they start to reduce the employment in their businesses. And typically a rising employment rate and claims is the last thing. So it's a lagging indicator of the economy. So let's go back to the second quarter of results. US corporates grew in real terms about 20 basis points. So they're not growing at all. Remember, we had the first rise in interest rates around 19 months. So really things are feeding through very much as, the last 7 business cycles since the Second World War would suggest they should be. Of course, higher inflation has been helping the reported revenue growth. I think in the second quarter in the States, it was about 3.6%. So that's the dynamic I think that you should expect really the market's going to be focused on as we move into the reporting season. What is the outlook for top line growth? Because as that slows and as it nears zero in nominal terms, because we're already there in real terms, that's typically where outright aversion in the equity market takes hold. And of course, stability and visibility of earnings becomes really the dominant driver of share price relative performance.
So you're therefore expecting further weakness in the US economy, to the point where they could fall into recession, and how does that play out for those corporates as a result?
Yeah, so listen, I'd like to say that we're not in the business of forecasting, but we are pretty keen students of history. And I think that the light at the end of the tunnel that you see is really a locomotive with kind of recession written across the front of it. If you've looked at the past 7 business cycles, so what kind of things am I referring to? Clearly, the inversion of the yield curve. And the length that we've had that inversion. If you have a look at post Second World War, when inflation's gone through 5%, the US economy has never avoided a recession. If you have a look at the senior loan officers' intention to lend survey, so the SLOOS as it's called, closely watched, that's deeply in tightening and contractionary territory. All of those things historically have been harbinger of slowing absolute GDP growth in the economy.
Hugh, do you feel as though the US market has been distracted by that outstanding growth we've seen, particularly by the Magnificent Seven? And I see that you point out that what's going on with the Russell 2000, for instance.
Yeah, I mean, the Russell, for example, which is a much broader index. It's really about small and mid-cap stocks. That's down 25% from the high, Andrew. Where now we've seen the Dow obviously turn last night in the session to be down year to date as well. And that's no surprise. I mean, the access to credit in the small and mid-cap space is always going to be tighter. They're going to have to pay higher relative cost of financing, and their access to equity markets as capital raising is also relatively smaller than large capitalization companies. And so the rise in rates is really feeding through already into some pretty strong financial distress in that space. I mean, there's been a sharp pickup in corporate bankruptcies in North America, for example. So I think that is really part and parcel where mega cap companies do have an advantage in terms of financing themselves. In terms of getting away a little bit from the Magnificent Seven, but still sort of touching on that. If you have a look at individual sector characteristics of performance, year to date, you've seen financials, materials, and energy be the weakest part of the market. You've seen, apart from the last couple of days, the likes of utilities and healthcare and so forth, staples, broadly secure, visible revenue stream companies, not really going anywhere. And then as the economy and top line growth has slowed, the market typically bids up those companies that they perceive as being able to continue to be able to grow in a slowing growth environment. And that's exactly what we've seen. So not only the Magnificent Seven, but also, the likes of consumer discretionary and the like. So I think there's nothing so far that is really out of sync with the business cycle so far in terms of that lagged impact of monetary policy feeding through into the economy. And there's nothing really from a stock market cycle either that is noticeably different since those sort of 7 stock market cycles of the post Second World War.
So, Hugh, given what you've said then, how should you adjust your strategy when you're looking to invest in equities in the States?
Well, I think we've touched on this before, Andrew. The key absolute thing at the moment is to focus on balance sheet strength. It's not only the metrics of debt, but really the absolute level of debt, because there is a risk here that spreads start to go wider. So that's the compensation over the Treasury market that investors in corporate debt want to receive. And that's typically cyclical. So that can widen, and clearly if you've got a large absolute level of debt, then that's going to cost you, and it affects the value of the equity because they are subordinated in the capital structure. And the second thing is clearly the absolute level of debt also means that you've got a refinancing risk. So I think the first absolute thing I would say to people listening is focus on the balance sheet, because that is your best defense in terms of protecting equity. I think the second thing is that you want to be focused on areas that exhibit good value, because if we are going to move more into this aversion phase, then really what we're talking about is the price that people are prepared to pay for a certain stream of cash flow starts to get lower. I mean, this year's rise in markets at the absolute level because of those Magnificent Seven has been that people are simply prepared to pay more for the same level of cash flows, and that works in reverse. And then the third thing is I think investors should have a realistic expectation that they need a more balanced approach in terms of total return between the capital component, our share price is going to go up, and the income component. So that would be our sort of 3 key takeaways, I guess, for people watching this morning.
Hugh, do you have any recent examples of perhaps stocks you've added to the portfolio, others that you've jettisoned?
Yeah, we've recently added Roche, the Swiss pharmaceutical company. We've touched on that before. We just started initiating a position, I think, last time we talked, Andrew, and we've sort of been scaling in. That's a company where all their cash flows of the major businesses in terms of business lines, which is really drugs in oncology and MS and so on, are patent protected. So you have good visibility on that. They spend around $13.5 billion on research and development. That's above the line to really drive future growth. And currently the market is suggesting that of that spend, around about 100 billion is going to be spent by the company. So, about 7 years of R&D spend, and they're not going to get a dollar back. And yet, if you have a look at the 15-year track record of the company, they've been able to generate over 3 times the revenue that they've invested in terms of R&D as it flows through the company. So I think that looks a pretty good place to be. Appealingly as well, it's a dividend aristocrat, so it's never ever cut the dividend. It's grown solidly, the dividend, over the last 30 years, and it's really got virtually no debt. So that sort of fits the bill. The yield in Swiss francs, so pretty strong currency as well, is well over 4%. So that's the kind of equity that I'd be describing, that fits into what I was describing.
Hugh, thanks so much for giving us a glimpse of your strategy there at Talaria. Thanks for joining us.
Always nice to see you, Andrew. Thank you.
All right, that is the global view. Just before we go, a check of the market. Look, we are expecting further selling today. As you can see, SPI futures off around 0.5%. Stay with us. The open just around the corner.